Welcome to this explainer. Today, we're going to completely demystify how capital-intensive businesses unlock their cash flow. And trust me, we're also going to look at the severe tax and accounting traps just waiting for them if they aren't careful. We're going to cover everything from the daily grind of paying suppliers right up to massive, multi-million-dollar real estate transactions and really decode the financial engineering that makes all of it possible.
Here's our roadmap for today. We've got 1. The working capital crunch. 2. Factoring versus AR financing. 3. The sale-leaseback strategy. 4. ASC 842 accounting traps. And 5. The tax substance test. We'll start small and scale up, seeing exactly how liquidity works at every single level.
All right, let's jump right in. Section 1. The working capital crunch. We're starting with a universal problem for heavy industries like construction or trucking.
To put it simply, working capital is the liquidity you absolutely need to cover short-term obligations, things like materials and labor, without having to rely on outside financing. Imagine you're a construction contractor, right? You often have to go out of pocket to buy materials and hire labor months before a client actually pays you for a project milestone. It is a wildly stressful gap. Well, that gap is exactly where working capital comes into play. It's simply the difference between what your business owns in the short term and what it owes.
Now, the golden target here is a current ratio of 2.0. That essentially means you have twice as many current assets as current liabilities, giving you a really solid cushion to weather delayed payments or sudden economic shifts. If you drop below 1.0, well, you're effectively operating with negative working capital. That means you might have to delay paying your subcontractors, which, as we know, ruins relationships and stalls projects entirely. So, what on earth do you do when your capital is locked up in unpaid invoices?
That brings us to Section 2, Factoring versus AR Financing.
So what if you are completely cash-strapped because of those unpaid invoices? This is incredibly common in the freight and trucking industry. Terms can stretch 30 to 60 days, but your drivers, they need fuel and payroll today. The crucial choice here is between maintaining control of your customer collections with an AR loan or just outsourcing the headache entirely through factoring. With AR financing, you're basically getting a bank-style line of credit secured by your invoices. You still own the invoice, and you still collect from the client. Factoring, though, that's not a loan. You literally sell the invoice to a third party at a slight discount, they give you the cash up front, and then they collect from your client.
When deciding between the two, you're really trading off speed for cost. Factoring offers much higher advance rates, sometimes up to 95% upfront, at lightning speed, often the exact same day. But it definitely comes at a higher all-in cost compared to a traditional AR line of credit. You also have to keep customer notification in mind. Because the factoring company bought the invoice, they're going to notify your customer to pay them directly. If keeping that direct billing relationship with your client is a deal breaker for you, AR financing is absolutely the way to go.
Now, if you do choose factoring, you've got another big decision: recourse or non-recourse. With recourse factoring, you have to eat the cost if your client ultimately doesn't pay the bill. It's cheaper, but way riskier for you. Non-recourse factoring costs a bit more, but it completely shifts the risk of debtor insolvency over to the factor. But hey, beware the catch here. Even with non-recourse, if a client short pays you because of a dispute or a silly documentation error, you are still on the hook.
Moving right along to Section 3, the sale-leaseback strategy.
For businesses with massive amounts of capital tied up in real estate or heavy equipment, we need to scale up to macro, long-term solutions. Let's say you own your corporate headquarters. It's incredibly valuable, right? But it's an illiquid fixed asset. You can't exactly use brick and mortar to make Friday's payroll. Enter the sale-leaseback. You sell your property to an investor to secure an immediate, massive injection of cash. But here's the genius part. You don't move out. You stay exactly where you are by leasing the property back from the new owner, paying rent over a long-term net lease. You get the cash, the buyer gets a steady return and tax deductions, and your daily business operations completely uninterrupted.
Okay, Section 4, ASC 842 accounting traps.
Because we all know financing is never truly free. Under ASC 842 accounting rules, poorly structured sale-leasebacks can turn into massive accounting traps. The whole outcome of your deal hinges on two very different accounting treatments. If you qualify for sale treatment, it's a clean break. The property leaves your balance sheet and you recognize an immediate gain. Sounds great, right? But if your deal fails the revenue recognition test, you get stuck with financing treatment. The property stays on your books, it keeps depreciating, and that big pile of cash you just received, it gets recorded as a massive financial liability. It's essentially a loan in disguise, which can absolutely wreck your leverage ratios and debt covenants. It is a true nightmare for any CFO. So what actually springs that trap? The core question for the accountants is whether the buyer actually obtained control of the asset. If you lease back 90% or more of the property, the rules basically say, well, you never really left, so you never really sold it. Similarly, if you hold an option to buy the building back later for less than fair market value, it proves the buyer never truly took on the risk and reward of ownership.
And finally, Section 5, the tax substance test. Because, honestly, it's not just the accountants you have to worry about. Beyond GAAP accounting, the IRS is watching these deals like a hawk to make sure they aren't just substantive shams cooked up for tax avoidance. The allocation of rights and tax benefits here is an incredibly complex puzzle. The buyer usually wants to claim Section 167 depreciation deductions, while the seller wants to deduct their Section 162 rent payments. But the IRS will scrutinize the deal strictly. The benefits have to reflect true ownership and genuine economic risk, not just clever paperwork.
Which brings us to a really fascinating piece of legal history, the landmark Supreme Court case Frank Lyon Company versus United States. The court ruled that a valid sale-leaseback has to be compelled by actual business realities, like a genuine pressing need for capital. It must have real economic substance, and the lessor must retain the significant attributes of a traditional owner. As the court famously noted, you can't just shape a transaction solely for tax avoidance and slap some meaningless labels on it.
So what does a sham actually look like to the IRS? Well, if your transaction relies on circular payments, say the buyer's loan payments are perfectly offset by the seller's rent payments, so no real money actually changes hands after closing, the IRS is going to flag that immediately. If you use defeasance arrangements that magically eliminate all financial risk, or if the only real point of the deal is to generate economic tax losses, the government will flat out deny your deductions and could potentially hit you with some hefty penalties.
At the end of the day, whether you're factoring trucking invoices to get immediate cash for fuel or you're navigating a massive commercial real estate sale-leaseback to fund a new acquisition, the core principles of liquidity are exactly the same. The structure matters, the economic reality matters, and the accounting rules, they are unforgiving. So we'll leave you with this provocative thought as you navigate these tools to unlock capital. Are your assets truly working to grow your business, or are you just working to finance them?